From the advisory group. Stock markets and bond markets were strong after a Fed rate cut. Expectations for mega cap and growth stocks are cooling. The economy is doing better than expected, but with signs of cooling. Interesting personal wealth investor tax reduction strategies. We'll cover that and more today in the advisory group's quarterly context presentation. This presentation is for the third quarter of 2024 for friends and clients of the advisory group. I'm Greg Patterson, CEO, and today we also have with us one of our advisors, Kyle Dodson, who will be presenting on the tax strategies mentioned a moment ago. For those not familiar with the advisory group, we are a wealth and life strategy firm focused on helping business owners and leaders and others with their financial goals in their personal and family realms, their fiduciary and employee support efforts through retirement plans, and their communities through endowments. To complement the strategic work we do with clients, our quarterly context webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, and investor behavior patterns to help both personal wealth and institutional clients stay more relaxed and more effective by being more informed and make better decisions towards your goals. We have the primary section of this presentation, which we'll cover today. We won't be recording the second section, which has more details. And if you're a client and would like to go over more details, just let us know. We try to keep this meeting to about 20 minutes, a little bit more, and we'll circulate a video link should you like to view some part of it again or pass it on to someone you think we can help, like we've helped you. And if you have any questions, please submit them into the question box, and we'll either address those as we go along or towards the end. So as always, we like to remind people to focus on the space between the things that matter, things you can control, you can't control interest rates or employment levels or the economy, but you can control how you respond to markets, which is oftentimes easiest when you have a long-term strategy and planning to help you focus on that long-term goal rather than the short-term noise. The advisory group is all about helping clients in a conflict-free, fiduciary method, process-based, with a talented team and deep resources to help you accomplish your goals. The best of boutique and big, we all sometimes say, and sometimes some of our clients refer to us that way. There's always a wide array of news items that happen that may cause markets to bump around a bit in the short run. In the long run, that all smooths out into the bigger picture. And while markets have been solid in the last 10 years with a few good-sized hiccups all along that path, it wouldn't be surprising, given how markets have been stronger than usual on average in the last 10 years, that there could be some cooling, some volatility. And as news comes out, just keep that in mind, that that's normal. Volatility is normal. Higher levels of volatility is more normal than what we've seen on average in the past number of years. In terms of an economic snapshot, the biggest news of the quarter was the 0.5% rate cut in mid to late September. This was after 11 consecutive rate hikes from 2022 to early 2024. Then the Fed's range now is right around that 5% mark. This had an interesting impact on both stock and bond markets, and we'll show that in a moment. This happened after the Fed saw progress towards their inflation goals of 2%. Inflation has tempered, which is part of what helped the Fed feel comfortable cutting rates to about 2.5% versus 3% a few months back, and the peak inflation level of 9.1% in the middle of 2022. Stock and bond markets have been interesting, up strongly in both cases, 6% for stocks and an even more impressive 5% for bonds. Not uncommon when rates cut. As rates get cut, interest rates fall. That pushes bond prices up because the existing bonds are with higher rates are viewed as more valuable, so that tends to push those prices up. Also interesting, the small cap stocks had a 9.3% return over the broad market, small cap has been a bit out of favor. So there are several different asset classes that have been out of favor that are gradually seeming to return to favor, and that will benefit investors who've been disciplined about those holdings. Similarly, large cap value significantly outperformed large cap growth. Large cap growth has had a strong advantage on average over the past number of years, especially because of a number of mega cap growth companies. And we'll talk a little bit more about expectations about that later. Unemployment ticked up a little bit to 4.2% versus 3.8%. And overall GDP, as of the finalized numbers for the second quarter of 2024, 3% up a bit from the cooled numbers of the first quarter, and an overall 2024 third quarter estimate, or the third quarter estimate from the Fed at 2.5%. We'll see how the third quarter shakes out. It always takes some time for those numbers to settle in and get finalized. Again, the big news was the cooling. You can see a little bit of a rate dip here at the end of this chart after going through a rate hike period in the 70s and 80s. This is the next highest period of rates. Then the historically bottom of the barrel low rates ratcheted up as the economy was doing better. Then COVID happened and the rates were brought back down to stimulate the economy, held near 0%, and then gradually worked their way back up as the Fed tried to rein in inflation in order to prevent bigger economic consequences. The rate cut of 0.5% or 0.5% was much larger than normal historically. The last two times that happened was in 2020 and 2008. It's much more common to see a quarter point change, and the expectations about future rate cuts are closer to the quarter point or 0.25% mark. You can see here the projections over time from the Fed and the market. And the Fed is projecting only one additional cut in 2024, whereas the market is projecting 2 to 3. The market is expecting a bit more economic cool down than the Fed at this stage, and we'll see where that ends up. Inflation has come down. The Fed's favorite measure is the PCE index, down to 2.2% versus 3.3% a year ago. CPI, which is the more broadly known measure, down to 2.5%, and core CPI at 3.2%. That core CPI number has been significantly influenced in inflation in general due to the housing shortage, which has pushed prices up. If you remove housing, the core CPI number was at 1.8%. So that's an important factor there, and not one that's easily shifted. It takes a while to build homes. The unemployment numbers have, as mentioned, ticked up a little bit, not dramatically, but hovering there, while wage growth has continued to cool down a little bit as jobs are a little bit more scarce and the labor market a bit more competitive. Overall, consumer confidence took the biggest dip we've seen in a while, in about 3 years. So you can see cooled down here. Not entirely surprising, given that even though inflation has cooled, a decrease in the rate of increase doesn't mean that actual prices have dropped. It just means that the speed of increase has slowed down. So the lower prices, if wages have remained static or wage growth has declined, that can put a squeeze on the average consumer and can hurt their confidence. And if markets are getting a little more volatile after a period where it seemed like markets were not too bumpy, and other factors, consumers tend to become a little more concerned and a little more cautious, and that can increase the chance of a slowdown because that decreases disposable income and spending. And the consumer represents about 70% of GDP. So what the consumer does can have a material impact on the degree of slowdown to the extent that happens. Debt has also been increasing, whether it's car loans, home loans, credit cards have seen some cracks in terms of default or late payments and so forth. And that's a sign of a little bit less economic resiliency out there for the consumer as well. So all of that leads up to the question of, what will there be a recession, and how big and how deep? No one can predict that yet. It seems like the soft landing has been happening, but there are concerns and some signs in the economy that things are cooling. The question is, how much will it cool? And this is where the Fed is struggling to decide how much they should cut rates without triggering an additional sequence of inflation. So the Fed has a very tricky role at this stage. Has done an amazing job so far, but not an easy job. We talk about markets, again, very strong for the quarter, really across the board. Real estate went through the roof for the quarter. You can imagine I've been depressed a little bit for a while relative to some other markets because of higher rates, as rates and the expectation that rates will drop has given real estate a boost. Emerging markets and international did quite well. The U.S. stock market also very strong. This is represented by the S&P, the Russell 3000, which is in many ways, because of the market capitalization weighted nature of that index, similar to the S&P 500. And as mentioned before, small cap stocks were in the 9% range in the U.S. So very strong results. In bonds, because of the rate cut, also had a big bump up. So a lot of green here, but again, whenever it's all green, that oftentimes is followed by some red some point around the corner. Hard to know how much red and how deep that will be. If we look at the long different periods of markets, we can see one of the things we've been talking about over the last number of years is how large cap growth, driven by the relatively small number of mega cap stocks, we refer to oftentimes as the Magnificent Seven, have done very well. And that oftentimes, the longer something is stronger, the more likely there's some cooling around the corner. And if we look since the market's low, it's not surprising that even though these are some solid numbers here for small cap, not surprising that there would be some relative cooling in large cap and some bounce back in smaller cap stocks. So being disciplined about asset allocation and staying with the asset classes that are relatively out of favor pays off over time, even though it's tempting to be concerned about something that seems to only go up. But as you know, and as we know, nothing only goes up or always is in first place. In terms of the bond market, you can see here the yield curve with the rate cut and the market response has shifted downward, leading to, well, the short end is still creating an inversion. The rest of the curve is a little bit more normalized, where quasi shorter end is lower than the long end bond. So this is beginning to take the shape of a more normal bond yield curve. And there's some question about whether or not some of the shorter end bonds might be a little bit stretched in terms of valuations with better price valuations farther out along the curve. And this, again, as mentioned before, when bond rates fall, bond prices rise, and that led to some strong markets and bond returns. In terms of valuations and on the stock side,
Hey Greg, just let me know that I lost audio again.
the valuations of stocks look in the U.S. look a bit stretched. Some would say more than a bit stretched, but again, that story depends on which segment of the market they're looking at. Overall volatility has picked up quite a bit recently. This has come primarily, although not entirely, from some of those mega cap stocks, concerns about how sustainable their high returns have been, and questions about artificial intelligence's ability to have the impact that was priced into those mega cap stocks and others, but not in the extreme volatility levels here, or just entering maybe a more normal level of volatility. Regarding artificial intelligence, some interesting scenarios to mention here that some organizations and people are thinking about. The expectation of what AI can do led to a big boost in prices for, again, a lot of those mega cap stocks and other companies. But as the question continues regarding what the actual impact can be, will be, how quickly that will be implemented, hiccups in the IA space, that has increased in volatility, and a couple scenarios here. If AI does more poorly than expected, that could lead to less productivity in the economy than it's currently priced into the market, and overall GDP could cool. That would lead towards more of a recessionary environment or an economic cooling at least. And at least in this scenario, Vanguard as one organization places a 30 to 40% probability on that, only a 10 to 20% probability on the status quo, and about a 50% probability on the idea that AI will continue to be transformational and improve productivity. So higher expectation of it going either better than expected or worse than expected than the current. So this is why volatility may pick up as uncertainty increases. On a similar or indirectly related note, here are some projections also from Vanguard. There's some other organizations that have some thinking like this as well. This is different than the Cowen capital market projections that we use for modeling for portfolios. These numbers break it down into sub-asset classes, growth, value, and so forth. And as mentioned a few moments ago, and as we've been talking about, and regarding valuations and large cap growth in particular, with prices being high and possibly stretched, projections, 10-year projections for large cap growth are in the essentially 0 to 2% range. So that's a 10-year average, whereas value closer to 6%, small cap closer to 5 to 6, and international equities, which have been out of favor for a number of reasons, delayed economic recovery, currency differences with the U.S., and so forth, are the highest in the 7 to 9% range in terms of expectation. So, and then bonds are priced maybe more similar to what projections are that we've been talking about before. So we will not be modifying our portfolio design in terms of capital market projections related to this, but it's important to be aware of, and we have adjusted a few quarters ago, decreased some exposure to growth and increased and maintained value in small cap holdings, which have had an overweight in the portfolio and have been in client portfolios and have, as a result, been have trailed a little bit relative to some portfolios out there that might have overweighted mega cap growth, but that mega cap growth volatility may be picking up on the horizon, and that's part of what's reflected here. So the overall reminder here is we don't plan or suggest making a dramatic portfolio design difference, either in your stock bond mix necessarily or your value growth small allocations, but rather that the long-term approach that is used if you have healthy allocations to sub-asset classes that have been underperforming because they've been out of favor. This may be when some of the next number of years may be when the patience gets rewarded. And as mentioned, with small cap outperforming by 6% versus large cap in the third quarter, that may already be starting. Another thing that's on people's minds is elections. People wonder what happens. We've shown charts in past years to show there's no material advantage of returns of one party being in power versus the other. And here we can also see that the difference in returns in election years versus non-election years tends not to be dramatically different. In fact, presidential election years tend to be a little bit stronger than non-election years. But no clear pattern of weaker markets, which may provide some comfort. Now, there are some maybe larger concerns now for some people regarding who comes in office and what that candidate and future president might do. There's also a larger deficit than there has been, and the way policy responds to or increases or manages that deficit will have implications for markets and tax policy as well. So not expected that, at least in the short run, that there would be any major market concern specifically related to elections. And again, these long-term numbers tell a good, provide some insight regarding the long-term patterns. With that, I will turn it over to Kyle, who will run through some of the tax efficiency and year-end tax planning topics that may be helpful for you.
Yeah, thank you, Greg. We just wanted to cover a few year-end tax planning items to keep in mind as we quickly approach the end of the year. First one being here, you're seeing required minimum distributions, also known as RMDs for short. Simply stated, these are the amount an investor is required to distribute out of a pre-tax retirement account every year once they hit a certain age. And you'll see the account types that are affected are the tax deferred accounts, so IRAs like traditional, SEP, simple IRAs. You'll see that Roth IRAs are not included as they're exempt from required minimum distributions. And you also have employer-sponsored plans like 401ks, 403bs, and 457bs, as well as small business accounts like self-employed 401ks, profit-sharing plans, and money purchase plans. For age and timing, the Secure Act 2.0 updated the age at which an investor is required to take RMDs. So for investors that reach age 73 before January 1, 2033, their RMD age will be 73. And then if you reach the age 74 after December 31 of 2032, your RMDs will start at age 75. And in terms of timing, investors must withdraw the amount of their annual RMD by December 31 of the current year, unless it is your first year of beginning RMDs, in which the IRS gives you until April of the following year. And the other caveat there is if you are of RMD age and have an employer-sponsored plan like a 401k, and you're still working, you are not required to start RMDs until you retire, unless you are a 5% owner of the business. Some tax implications. So RMDs are taxed at the investor's ordinary income tax rate, and we always advise clients to withhold taxes from their distributions while they happen to avoid a large tax bill in the following year. And then we have some tax planning strategies as well that we'll discuss in more detail in the coming slides. But qualified charitable distributions can be used to lower the tax consequence of an investor's RMD in the current year. And taxable Roth conversions is a more complex strategy that we plan to cover in more detail in future webinars. But it's a way that investors can lower the tax consequence of their RMDs for the life of their retirement plan. You'll see this detailed quickly just to give you a visual of the power of Roth conversions and how they can save taxes in your retirement plan. We've got a visual here, and what I want to direct you to is the left-hand side of the chart that shows the tax brackets, and the chart itself is a model of a retirement income throughout an investor's lifetime. And the other component of this chart that I want to direct you to is the white bars that emphasize the investor's RMDs. And you'll see in this chart where we're displaying no Roth conversions, the RMDs are well into the 24% bracket, well into the 32% bracket, and even approaching the 35% bracket. You'll see on the next slide here, when we introduce Roth conversions early in an investor's retirement where they have lower income, that black bar is the Roth conversions. We're essentially targeting the 22% tax bracket, electing to pay more tax early in retirement, and you'll see the effect this has on the investors' RMDs, where they're just barely breaching the 24% tax bracket at the end of their retirement plan, saving on taxes throughout their life. So that's a quick explanation and visual of what Roth conversions are and the power of them. But yeah, happy, we're going to explain these in more detail in future webinars.
I think that'll be an interesting webinar with more insight on that.
Yep. So yeah, last item here for year-end tax planning is charitable giving strategies, and we have 3 strategies here that we feel are just more tax efficient ways to donate to charities rather than just donating cash. First one here being appreciated stock. So investors can give low basis stock with large unrealized capital gains directly to charities, and the investor actually receives a tax deduction on the amount that they donate. And what this essentially does is allows investors to donate a larger amount to the desired charity if the alternative would be to liquidate that stock position, pay tax, and then donate the excess cash, what's left. The charity doesn't have to pay taxes on those capital gains, so they can receive the entire donation and avoid that tax consequence. Next one here is donor advised funds, or DAFs for short. So a DAF is a type of charitable investment account where investors can contribute assets to the donor advised fund and receive a tax deduction in the year that they contribute to this account. And then these funds in this account can be used to donate to charities at a later date. So a popular strategy that we see with DAFs is called bunching contributions. So an example I'll use is, say an investor wants to give $20,000 per year to charity. And that $20,000 is great, but it may not be enough to exceed their standard deduction for that year. So what we can do is utilize a donor advised fund to give maybe multiple years of charitable giving. So say an example, $60,000 in the current year, the investor can receive that tax deduction that exceeds their standard deduction, and then utilize that donor advised funds to give directly to charities over the coming years, 2-3 years down the road. I will say that the IRS only lets you take a deduction in the year that you donate to or contribute to the donor advised fund. And then later on, when you utilize the funds out of the donor advised funds to give to a charity, you don't receive an additional deduction there. And the last item here is qualified charitable distributions that we briefly touched on earlier, also known as QCDs. So what these are, tax-free gifts to qualified charities out of a tax-deferred IRA. Investors are eligible to use QCDs once they reach age 70 and a half or older. And the maximum amount you can give utilizing a QCD is $105,000 per year in 2024, and this will bump up to $110,000 in 2025. And how these QCDs can be used to minimize the tax impact of an RMD in a current year is that they actually count towards an investor's RMD. So a quick example I'll use is, say an investor's RMD is $100,000 and they utilize $50,000 as a qualified charitable distribution, or QCD. The investor would only be required to pay taxes on that remaining $50,000 of required minimum distribution for that year. So just some really effective strategies for tax efficient donations to charity. That's all we're going to cover, and we'll say any questions you have, or if you think that any of these strategies could be useful in your personal financial situation, reach out to an advisor at the advisory group. We are happy to explain and help in more detail. And I'll give it back to you, Greg.
Perfect. Thank you, Kyle. Helpful information. And again, the topic of the Roth conversion strategies is something that will you'll see an upcoming webinar at some point in the future on that. So thank you. Well, to finish up here, just remind you that we have some articles that may be of interest on our blog under the Insights section. Top financial mistakes, co-housing, interesting co-housing discussions and questions that may be an interesting way to maintain community, different later ages, and other related topics, and how the investment process quality is central to the overall, or a key element as part of the overall planning process, and other topics as well. So let's hope you find that interesting. So, as mentioned before, we have some more nitty-gritty details for anybody who would like to see that. Just reach out to us. Happy to run through some of those. And I want to thank you for joining us today. If you have questions or want to reach out, information is shown here. And we look forward to helping you and others that you think we can help, like we've helped you with your client. And it's our honor to help and serve you and others to improve lives and through financial advice.